to Caledonia Mining. We're a Zimbabwean gold mining business. I'll draw your attention to our disclaimer. You can read that at your leisure. We released our Q1 results last week. I'll go through those briefly now. It was a good year-on-year quarter for us, not quite as good as the last quarter of 2017, which was a record, but a very healthy increase in EPS, which we monitor quite closely. So earnings per share almost doubling. Gold production up 18%, slightly higher gold price as well, so that helps on the revenue side, and all-in cost down 10%. So all the needles moving in the right direction. The operations remain cash generative, so all in all, a reasonably healthy quarter financially. An overview of us as a business. We are, as I said, a growing Zimbabwean gold producer. We have an asset in the Blanket mine, so we're essentially a single asset company, which is the Blanket gold mine in Zimbabwe. We're in reasonably good nick financially. We have a pretty robust cash position. We've got 11.7 million in the bank, and our results published last week. No debt, and we're on a pretty healthy growth trajectory. So this mine produced about 40,000 ounces in 2015, 50,000 ounces in 2016. We're guiding between 52 and 57,000 ounces in 2017. And we're investing to grow this production to 80,000 ounces by 2021. On a cost basis, our all-in sustaining cost for the business were $857 last quarter, and were $912 for 2016 financial full year. So again, costs are trending also in the right direction. And like I said, we're in the middle of a capital investment project to grow that production to 80,000 ounces. We're about 60% of the way through that. Importantly, this is the last big capex year where we're spending most of the money, and then we'll be reaping the rewards of that for hopefully many years to come. We also pay a dividend, which is unusual for a gold mining junior. The yield's just over, it's about 4.5% now, because the shares have pulled off a bit. But as of that date, the yields was over 4%. So Zimbabwe, about 80% of the questions we get in forums like this don't deal with the quality of the asset, don't deal with the business, how it's performing. It is a great asset, which we bought off Kinross in 2007 when they were exiting Zimbabwe. The questions are around Zimbabwe and what about the country and the political risk. So we try to deal with it head on. We don't want to be Pollyannas about it. The country has problems. But from our perspective, we have everything we need to operate a gold mine. It's a relatively small-scale mine. These type of businesses don't depend on large infrastructure such as pipelines and railways. We can fit a month's production into a briefcase if we needed to. I mean, we don't do that, but we have the asset does not depend very heavily on large infrastructure. We have grid power. We have tarred roads all the way to the mine gate. We're an hour's flight and 3 hours drive on a paved road all the way to the gate from Johannesburg. If need be, we can put critical spares on the back of a truck and have them at the mine in 24 hours from Johannesburg, and we've done that in the past. So infrastructurally, we have everything we need to operate a mine. I'll deal with the other major issue, which some of you may be aware of, is the local indigenization legislation. Legislation in Zimbabwe requires local Zimbabweans to own 51% of all businesses, and they're particularly passionate about that in the mining industry. We're the only mine publicly listed, I think one of two, that are compliant with this legislation. So we own 49% of the asset, and local partners in Zimbabwe own the other 51%. Those partners are essentially four entities. There's the Zimbabwean government, who own 16%, a group of Zimbabwean businessmen who own 15%, our staff on the mine, so we employ about over 1,200 people. They have 10% of the asset, and the local Gwanda community. Gwanda is the town near which we operate, and they have a 10% stake. So we have very good, say the community and the workers have skin in the game. They're heavily incentivized to make this work. We believe this structure gives us a tremendous amount of political goodwill. If there ever was a situation in Zimbabwe like they repossessed the farms without compensation, if that ever did come for the mines, we don't think it will. We think we'd be at the back of that queue. So because the mine is majority owned by local Zimbabweans. Importantly as well, this structure was put in place via a vendor finance loan. So although we only own 49% of the asset, we get more than 49% of the cash flows because the 51% owners didn't have the money to buy their 51% share. So we loaned them the money, and we are paid back. That loan is repaid by preferential rights to the dividends from the mine. When I say the cash flows that the mine enjoys, not the Caledonia dividend, the dividends from the mine until such time as that loan is repaid. So conceptually, the simplest way to think about us is as a 49% shareholder in the asset and carrying a $30 million loan, which is repaid out of preferential rights to dividends from the asset. The actual model's a bit more complex than that, but that's sort of conceptually the right way to think about it. I mentioned exchange controls. The Zimbabwean dollar collapsed in 2008. That's a 100 trillion Zim dollar note, which we had. We actually owned the mine during this time, and I mean, it's an amusing story after the fact. It was a tragedy at the time, but we could pay the entire wage bill of this mine as $5 of diesel for a month. It was that bad. I mean, I'm not making a representation on the monetary case for gold, which people must take their own view on. We're good at digging it up, but the economy has been suffering, and when things collapsed in 2008, there's been a fairly difficult time since then. There are manageable exchange controls, so we get our money out of the country. We get, in terms of the dividends from the mine, as well as sufficient capital to fund the capital project, buy raw materials, and operate the asset. So this is our capital structure. Like I say, we're sitting with 11.7 million in the bank. Our market cap's 66 million at the moment. So relatively tightly held, only 52.8 million shares in issue. Our largest shareholder is a company called Allan Gray, a South African financial institution. They're a fund manager in South Africa. Management directors own 2%. That might seem like a low number. There's certain various reasons for that. One, exchange controls in South Africa, where a lot of our management are based, prohibit people from buying shares in the company. I would draw your attention to the fact that we have a fairly significant long-term incentive plan, which is a cash-settled share option scheme, in a cash-settled share scheme in the company, which gives us a fairly strong incentive. A big part of my remuneration depends on share price performance over the next few years. So although we don't have large management shareholding, there is quite a strong incentive. We're strongly aligned with shareholders, and it's non-dilutive, so it is settled in cash. This is our reserves and resources. We are sitting on about 1.3 million ounces of gold. So about half of that is measured and indicated, which gives us a mine life of about 10 years at the moment. The comment I'd make on mine life, first of all, our track record of resource replacement over time has been very good. Over this period, since 2010, we've probably extracted over 250,000 ounces of gold from this mine, and we've continued to grow the resource base. So this mine is a vertical ore body. These type of deposits tend to extend very, very deep into the earth. And historically, these type of mines don't tend to die because they run out of gold. They tend to die because you don't fix the roof while the sun is shining. You don't invest adequately in enough infrastructure to keep going deeper and deeper to keep chasing the gold. This mine is 100 years old. It has never, ever had a 100-year mine life. So there's always a leap of faith from investors as to how much longer we're going to continue finding more gold. We're currently operating at a depth of 750 meters. I'll talk through the capital project we're going into and how that's going to set us up for the future. But practically, it gets prohibitively expensive and logistically difficult to keep drilling at depth from surface. It just can't be done within the required drill spacings to get a resource. So you can only drill 200 meters below you. We're currently at 750 meters. We have a resource down about 200 meters below us. We've drilled the ore body down to 1,200 meters, and we know the mineralization keeps going. We don't have a resource down there, but we know the mineralization keeps going. Our neighbors, who are 3 kilometers away, which in geological terms is very, very close, are operating at 1.5 kilometers. There's no reason, there's no guarantee we'll get down there, but if we're lucky and this keeps going to 1.5 kilometers, we'll be at this mine for much longer than 10 years. But that's the current stated resource base that we have sufficient geological confidence in. This is our production track record. So as I said, we acquired this mine from Kinross in 2006. It was in very good nick when we bought it, and it was in the process of investing in an expansion project, which they were finishing off. So some very good times here. This first arrow that I've highlighted, was essentially delivering rising gold production into a rising gold price, so it turned out to be a very, very good investment for the business. Phase 2 here, we were guilty, as many miners of these type of ore bodies are, of not investing adequately in infrastructure underground, not digging enough tunnels to get to the rock you need to get to be able to dig it up. So we had, when we encountered grade issues, which you see here, so high grade sections which we should have blended down, but we couldn't because we didn't have enough flexibility to work underground and get to the rock we needed to, and then potentially lower grade sections which we couldn't compensate with additional volume. We suffered on the production side. Our chief executive was replaced about 2014. We got an ops director who was an ex-Goldfields guy who joined us and set about this phase 3 here, developing an investment plan to set us up for the future. And we're starting to, we've been investing for 2015 and 2016. So far, we spent about $35 million, $38 million actually over the last 2 years. We're spending another 18 this year, and we're already starting to reap the rewards of that in terms of production. I'll talk through exactly what those plans are. So essentially, our investment plan to get us up to the 80,000 ounces is threefold. Firstly, increasing underground flexibility, just digging enough tunnels to get to the rock you need to get to. Very, very important, and something we actually announced last week in terms of we were previously guiding 60,000 ounces for this year. We're now guiding between 52 and 57, precisely because we've taken a strategic decision to not sacrifice that development and make sure that that when the new shaft is complete, that the tunnels will be in place so we can operate efficiently. Secondly, number 6 Winds, which is a sub-level shaft which takes us slightly deeper into the ore body. This is a band-aid solution for the time being. It gets us slightly deeper into the areas of rock below 750 meters where we're currently constrained, and is in production at the moment and building up by mid-year. But thirdly, and most importantly, a brand new central shaft. It's probably one of the biggest mining projects in Zimbabwe at the moment. It's a new shaft which runs from surface down to 750 meters, to 1,000 meters, and will set us up. I'll probably take on to the next slide. It's a good way to illustrate it. But because the mine's 100 years old, we often end up, and a lot of these old gold mines end up with infrastructure that grows organically over time, and you don't get a chance to have a clean copybook and build the mine the way you'd want to build it. So this is the mining, the areas of the ore body we exploit. So there's basically 4 distinct sections of gold-bearing ore. That's about 3 kilometers across, and that's about 1.5 kilometers, probably. I think that's about 1,200 meters there. So that is the 750-meter level where most of our resource, historical mining has taken place, and most of the previous resources existed. That's our current production shaft, the number 4 shaft. So this is the blanket ore body, which is where the mine gets its name. And then as these mines, as tends to happen in these areas, you start extracting ore from other neighboring places. So all of our production comes through 4 shaft. This is about a 2-kilometer journey. So our men come down a shaft over here, and then have to walk, either go further down in the 6 Winds shaft, which is this section. Sorry, I'll get to that. Down the 6 Winds, and walk 2 kilometers. It takes them over an hour to get to the rock face. And then all the ore's got to come all the way back along these tunnels, 2 kilometers underground in a little trolley, and then go up 4 shaft. This area here, that is the resource upside that I suggested was there earlier. That's where we know the mineralization keeps going. We've put drill holes through it, but we don't have enough holes to be confident about a resource. So we certainly don't feel resource constrained as a business, but these areas down here are where we would expect to find more gold and continue replacing those resources in the future. That's the central shaft. It is, like I say, we're very proud of this project and very excited about when it's going to be in production. It comes from surface all the way down to 1,000 meters. It will have 2 levels of development below the 750-meter level. We'll be mining these 2 legs of this ore body here, account currently for about 70% of our production, and that's going to continue this way into the future. It's, in some cases, very, very wide sections of rock, the size of the width of this room that we're extracting in these 2 AL Main and AL South ore bodies. So it's almost a bulk underground mining operation. We can keep our costs pretty low because of it, and it's and we'll be mining from 2 sides. So instead of here where you're mining all in one direction, you'll come in. The guys will come down this. They'll be at the workface. The shaft goes much, much faster. They'll be at the workface in 15 minutes instead of an hour and a half. There's lots of logistical advantage. This is how you would build the mine if you were doing it from scratch, as opposed to this historic inherited infrastructure that we've grown with over time. That's what it looks like. I took this picture when I was there last year. That's before we started. So there's our ops director and our mine GM and some of their people. This is what it means for production. So we produced, that was 42,000 ounces in 50,000 ounces last year. That's the mid-range of our current guidance and growing gradually to 80,000 ounces by 2021. As we get to 80,000 ounces, we will expect to see the fixed cost component of the mine, which is fairly substantial, spread over more and more ounces, and therefore we'll get the associated dilution of those costs getting down to, we expect our costs to get into the neighborhood of $750, somewhere between $700 and $800 an ounce. That doesn't bank too much on the logistical improvements of getting the men to the face quicker and all of those advantages. So if I were a betting man, I think we're going to do slightly better than that, but that's what we're guiding the market at the moment is $750 an ounce on an all-in sustaining cost basis, which current gold prices will be fairly profitable. This is straight out of our cash flow statement. So the grey line here is our cash balance over time. So as we've been investing in the mine, we've burnt through a bit of cash from the business. Importantly, that the burning through of cash is at a Caledonia level. The capital investment is funded by the operating company, and we haven't had to actually put any additional funds into Zimbabwe. But over this time, you can see the dark grey bars are the operating cash flow, and the light grey bars are investing cash. Over the last few quarters, what you've started to see is investing cash operating cash overtake investing cash. So cash has bottomed and is now, we don't expect the cash balance to go much lower, and we're starting to reap the rewards of the additional cash that comes from the asset. You can probably do the, this is one of my favorite charts of our project. This is our capital investment profile of the last 2 years. So we spent $18 million in 15, we spent $20 million in 16, we're budgeting 18 this year, and then the capex drops off quite substantially. So our full year results for 2016, we generated $23 million in cash, and the operating cash flow from the business, $23 million. We divvied out $3 million. Our dividend that we paid to our shareholders was divvied out $3, and we invested $20. So we pretty much kept the cash balance flat, which is what you see. What you see here is roughly the cash balance year on year was relatively flat. This year, we'll probably have a similar year because we're spending 18, we're divvying out 3. We'll probably have a similar year this year, and cash balance will maybe grow a little depending on the gold price, but roughly flat. Next year, if you've got the patience for it, we'll probably generate between 25 and 30. We'll still divvy out 3. That leaves us with, and we'll invest 8, and that leaves us with a lot of money to put in the till. We'll be in a position to increase our dividend very, very substantially over the next few years. And then getting down to here, this is probably a sustaining capital level going forward. So we expect to spend about $5 million keeping that development infrastructure in place. So the maths gets pretty easy. I mean, we'll be an 80,000 ounce producer at an operating margin, depending on your gold, at $1,200 gold, of somewhere between $400 and $500 an ounce, depending on where we end up on those all in cash. So that gives us EBITDA of anywhere between $30 and $40 million for a business with a market cap of 66 and 11 in the bank, so an EV of 55. We don't get all of that, like I mentioned, the indigenization structure we get, but for the next 5 years, while the facilitation loan that we extended to our indigenous partners is being repaid, we think this represents pretty good value. There'll be EPS of anywhere between 35 and 45 cents a share, depending on how things play out on the gold price. So we think relatively good value. I mentioned we pay a dividend. This is our yield it's actually dropped up a bit. So we're probably overtaken Pan African. We're about 4.5% yield at the moment. I'll just draw your attention to the payout ratios. We're keeping a lot of that in the bank, and that's not factoring in the earnings growth that we anticipate happening. So once the capital project is over, we could grow this dividend very substantially. So in the interest of time, I'm going to go through this fairly quickly. I'm going to skip that altogether. It's on our website if you like. So in summary, we believe we have a pretty good dividend, not the best in the sector. Our dividend used to be much higher, but the share price has rallied a little bit since then. So the kind of the right way you want to see a dividend yield drop rather than cutting the dividend. But given the growth profile we've mentioned, to get paid a dividend yield of 4.5%, 4 to 4.5% while you wait, we think is fairly attractive. We have high margin operations, so costs in the sector have been coming down. Gold mines have been doing a better job at managing their costs, but we still think no matter what happens to the gold price, we would back ourselves to survive at essentially any conceivable gold price. We have growth potential. I've just illustrated here, but if we do nothing, we're going to have a very substantially growing cash pile, even with an improved dividend. We are looking at investment opportunities. We're aware that the industry has a terrible reputation of spending the profits of a good mine on a bad mine, and we really don't want to be those guys, right? So we've got a great mine here, which is making us a lot of money, and we want to make sure we're cautious in terms of whatever corporate development strategy we do. And doing nothing and just giving the money back to shareholders as a divvy, I'm a shareholder, we all have some skin in the game, is a good option for us. And we have a strong management team. Most of our team are based in South Africa. Our FD sits in Jersey, and I'm in London. And we have very good relationships in Zimbabwe, and we think the numbers are starting to speak for themselves. So that's about it. I don't know if there's time for questions.
Hi there. I wonder what your safety/accident record is in the mine.
I don't know if you saw our announcement this morning.
No.
Okay. We had a fatality at the mine last week. Very sad, and the investigation is still actively ongoing. Prior to that, our safety record, and it's always difficult to comment in a very recent event. Prior to that, the last fatality we had was a heart attack on site, which we felt it still counted as a fatality, but was not much we could do about. And that was 2 years back, and then prior to that was an incident where somebody wasn't wearing their safety equipment. The one on Friday, we don't know what happened yet, so there's currently an investigation ongoing. So unfortunately, a live issue. If you'd asked me this question last week, I would have said very good, and it's very disappointing no matter what even if it turns out to be an incident where the employees sometimes don't wear the safety equipment, we still have a duty of responsibility to make sure that discipline is in place. So, yeah, unfortunately, not following the events of last week.
Okay. The second question was, who makes the decision on the dividend, given that you're 49% ownership?
No. So the dividend we pay as Caledonia is our decision, absolutely. So importantly, we get dividends from the mines. So Caledonia is 100% owned by our shareholders. We own 49% of the Blanket mine, which is then 51% owned by Zimbabwean partners. We have 4 directors on the board of the Blanket mine, and we have and our local partners. There's 4 of them have a director each, and the dividend is a joint decision made by the board of directors of Blanket mine. To be clear, there's very much aligned incentives in terms of who gets. Blanket has to pay a dividend to us in order to get a dividend to the local partners. In terms of the structure of the dividend, we get the $30 million facilitation loan, this notional loan that was extended to the Blanket 51% shareholders, is repaid by, we take 80% of their entitlement to dividends. So if Blanket was paying a dividend of $100, they would get 51, we would get 49. Of their 51, we get 80%. That's the conception. Again, there's a few nuances in there which I can talk you through in detail. But yeah, so for them to get paid, we need to get paid. Yes?
What's the timescale then for the repayment indigenization?
Depending on the gold price, by my spreadsheet, it repays anytime between 2022, say mid-2022, I think it repays.
So the present position enhances Caledonia's return because it's getting...
Absolutely, yes. We get, again, the actual numbers depend on the gold price. They depend on withholding tax structures in Zimbabwe. But we get about 83% of all of the cash flow out of this mine until 2022. After that, we get 49. So if you work on that basis, you'll be pretty accurate.
I had a question, if I may. Do Do you have any other exploration or kind of early stage projects in Zimbabwe or anything else that you're looking to do in country?
We are not scared of Zimbabwe. So yes, we are looking actively in the country. Last year we had a line item in our income statement for the evaluation costs, which were quite expensive. We got quite far down the line evaluating an asset in Zim. It was privately held, and we eventually walked away on friendly terms, but because of various reasons. We have our own exploration ground surrounding the mine, which we could explore, and we've got a mill that running at Blanket. So we have we have exploration properties in close vicinity, and then we have assets are cheap in Zim. The place is undercapitalized, it's not been adequately invested in. So as a place to invest our cash, we certainly do like the place geologically. We think it's underinvested and underexplored.
So without wishing to ask a leading question, there would be producers that would be the kind of the sweet spot for you to target? Rather than other exploration targets?
Ideally, producers who are in desperate need of capital. That would be the first one. And there are some of those, people who haven't had adequate capital, who haven't had time to invest. But we'd also look at projects. Finding new capital for Zimbabwe is difficult right now. People don't want to take $1 outside the country and invest it in the country. But we've got this goose that's laying golden eggs within the country. And we can look to deploy some of those funds in the country far more effectively than potentially an external investor would be able to put money in.
Great, thank you very much.
Okay, thank you,
Maurice.